In this video, I am going to go through a complete beginner's course on Forex trading. This is going to be very handy for some of you that want to learn how to start trading in the Forex market. Everything I'm going to teach in this course is beginner related. So after watching and learning everything in this beginner's course, you'll be very okay and good to start taking trade in the Forex market. Now, I also have like a course outline to guide us. I will make it like a playlist on this particular video. This is the introductory part of this video, and there are many other things that are beginner and core basics of trading in the Forex market. I'm going to teach you that. Right here we have introduction to Forex. We have how to place trades in the Forex market. We have Forex pips. I'm going to teach you all this. Forex lot size, best currency PS for beginners, bid and ask price, Forex sessions, how to calculate stop loss take profit, candlesticks, introduction to technical analysis. All these are beginner related. So I have made this like a complete playlist. You're going to find it on this playlist. You will find every single video after this one. So let's get back to our slide, and then I'm going to show you everything you need to know about the foreign exchange market. And trust me, after going through this course, you'll be very okay to start trading a demo account in the foreign exchange market. So let's start by defining what is Forex. The word Forex simply stands for foreign exchange, and it is the simultaneous buying of one currency and selling another currency. Currencies are traded through a broker or a dealer and are traded in pairs. For example, the euro and the US dollar, or the British pound and the Japanese yen. Now, you need to understand that every single country in this planet has their own currency, and that currency is the direct reflection of the country's economic strength. So in Nigeria, we have Naira. In the United States, they have dollar. The British have their pound, and the Japanese have their yen. So every country has its own currency, and that currency is the direct reflection of the economic strength. Of course, if you have ever traveled to another country and you went to the foreign exchange stand to exchange your country's currency for that country's currency, you have actually participated in foreign exchange, because what you're doing is simply exchanging one currency for another. And you cannot trade in the foreign exchange market with just one currency. You have to trade it in pairs, because if you are giving euro to collect dollar, you're actually trading in pair. Or if you're collecting dollar to give euro, or if you are giving dollar to collect euro, it is all the same. You're actually trading in pairs. For instance, an American traveling to Europe or a Nigerian traveling to Ghana, and vice versa, there arises a need to change your currency to be able to operate financially in the other's economy. And this is true, because if I travel to Ghana with Naira, I wouldn't be able to transact because Naira is not a legal tender in Ghana. If I travel to the US, I will not be able to function financially in the US because Naira is not relevant to them. I will have to get a dollar with my Naira. What will happen is that it will actually give the dollar strength, because demand makes the country's currency to be strong, and there are so many factors that makes a country's currency to be strong, but demand is one of it. So that demand on that particular country's currency will strengthen its economic value, and that will make the country's economy to be stronger. So you can see where foreign exchange comes into reality. Now, you need to know that foreign exchange market is one of the several financial market. We have different other financial markets, such as the stocks market, the bonds market, we have the equity market, different financial markets, and foreign exchange is the biggest of them all. We have the futures market, the cryptocurrency market. All of these ones are part of the financial market. So you can see this is a chart that is showing you how strong the foreign exchange is. It has a daily trading volume of $5.3 trillion, if not even more than that. This is more than 5 to 6 times the biggest stock exchange market, that is the New York Stock Exchange market. So you can see the foreign exchange market is the most traded financial market in the whole world. So I'm going to introduce you to that and how I will pick you through everything you need to know about the foreign exchange market. Make sure you stay to the end and subscribe to this channel in order to learn everything about Forex. This is a theoretical aspect of this course. I'm going to go through every practical aspect so you can get the best part of this particular course. The next one is the history of Forex. I decided to just give you a brief history of why Forex. Okay, history has it that at the end of the World War II, the whole world was experiencing so much chaos, such that the major Western governments felt the need to create a system to stabilize the global economy, known as the Bretton Woods system. So after the World War II, there was so much chaos in the world. Now the world and the Western government have to come together and come to an agreement. That was the Bretton Woods system when this initiative began. The agreement set the exchange rate of all currencies against gold, because gold is one of the most valuable minerals, and every country's exchange rate was set against the gold. This singular act stabilized the exchange rates for a while. But as the major economies of the world started to change and grow at different speeds, the rules of the system soon became obsolete and limiting. Now, what happened after that? Soon enough, come the 1971, the Bretton Woods Agreement was abolished and replaced by different currencies valuation system, with the United States in the pilot seat. The currency market evolved to a free-floating one where exchange rates were determined by supply and demand. You see what I'm saying? Now, let me give you this practical illustration. Nigeria is a petrodollar country. That means a country that exports crudes, that is crude oil. So if the United States is coming to Nigeria to buy crude oil, they will definitely need Naira to buy it, because the United States dollar is not a legal tender in Nigeria. So that demand on Naira will make Naira to increase in value, and the dollar will eventually depreciate, because your country has enough value that other countries are looking for. That country's currency will be in much demand, because every single person coming to buy crudes in Nigeria will need the Naira to transact and function really well. So that is why the Naira will strengthen in value, and then it will lessen the strength of those countries' currency. So this is basically what it is. With the United States in the pilot seat, the currency market evolved to a free floating one where exchange rates were determined by supply and demand. At first, it was difficult to determine fair exchange rate, but advances in technology and communication eventually made things easier. So guys, this is the theoretical aspect. Make sure you stay to the end, because you will need to know about this before you can start trading in the foreign exchange market. So what is traded in the foreign exchange market? The simple answer is money and their derivative. What is traded on the online Forex trading platforms? You are obviously not buying anything physical if you trade in the Forex market, and this can make Forex trading really confusing to some people. Don't worry, because everything you're buying and selling is like the derivative of that country's currency. Okay, when we discuss on how to place trade in the foreign exchange market, you will get to know about this. It's just like the derivative of that currency. It is not the physical currency you are trading, you are actually trading the derivative of those currencies. So currency pairs, currency symbols always have 3 letters. The first 2 letters identify the name of the country, while the third letter identifies the name of that country's currency. Take New Zealand dollar, for example. You can see NZD, for instance. NZ stands for New Zealand, and while the D stands for dollar. Easy enough, right? The NZ stands for New Zealand, and then the D stands for dollar. Take the USD. The US stands for United States, and the D stands for dollar. Take the GBP. The GB stands for Great Britain, and then the P stands for pound. So this is basically the simplest way you can understand how currencies are symbolized. Now we have the symbols. You can see USD, Euro, you have the JPY, Japanese yen, Great Britain pound, Swiss franc, that is the symbol for Swiss franc. We have the country, we have the currency, the nickname. It also have a nickname. We have the US dollar as the buck, we have the euro as the fiber, we have the Japanese yen as the yen, we have the GBP as the cable, we have the Swiss franc as the Swissy. Okay, we have the Australian dollar as the Aussie, we have the New Zealand dollar as the Kiwi. So this is the major currencies that are traded in the foreign exchange market. Please don't forget about this. We have major currencies that are traded in the foreign exchange market, and we have just 1, 2, 3, 4, 5, 6, 7, 8 of them. They are not more than 8 that are traded with a heavy volume in the foreign exchange market. The next one is the major currency pairs. Now remember, I told you that you can only trade in pairs. This is the pairs. You can see all of them are paired with one another. The currencies paired here are those ones that are paired with the United States dollar. We have the Euro USD, we have the USD JPY, we have the GBP USD, we have the USD Swiss franc. So these are the major currency pairs because they are major pairs that are paired with the United States dollar. That is why it is called the major currency pairs. So among the major currencies, if you pair every single one of this one with the United States dollar, you will have major currency pairs. And then the next one is obviously major cross currency pairs or minor currency pairs. Currency pairs that don't contain the US dollar are known as cross currency pairs or simply as the crosses. Major crosses are also known as minors. The most actively traded crosses are derived from the 3 major non-USD currencies, that is the Euro, the JPY, and the GBP. You're going to see all of them right here. You can see the Euro, the Yen, and then the Pound. So these are the major crosses that you can see on your foreign exchange market. Even though trading these ones comes with a lot of risks, you will need to be careful and you need to learn a lot about it before you can trade those ones. Exotic pairs, depending on your forex broker, you may see the following exotic pairs. So these are currencies that are outside the ones I've mentioned. Keep in mind that these pairs aren't as heavily traded as the majors or the crosses, just like I told you. So the transaction costs associated with trading these pairs are usually bigger. I will talk to you about transaction costs. You can either pay through a spread. I will explain what a spread is for you in this same course, or you can pay through commission. So these are the exotic pairs. You can see them right here. So let's go to the next thing, the participants in the industry. So you will hear me talk about the institutions, the big players, the institutions who are also called the key players. You can see these are the 2 major players in the market, the institutions and the retail or non-commercial traders. I am a retail trader, you are a retail trader. In the crypto world, we call the institutions the whales. You can see the super banks, large commercial companies, governments, and central banks. So these are the major players because they come with heavy money. Block transactions are done by them. So you have to take notice of these guys. These are the major players in the market, and then somebody like you and me, the retail trader that is there to make a daily means, that is there to make a daily profit in the foreign exchange market. So forex broker, I will need to talk to you about the forex broker. The forex broker operates as a middleman between you and the market. Broker simply means somebody that is mediating a business agreement between 2 people. In order to find a buyer or a seller of currencies, you can go to a broker and they match you up with either a respective seller or a respective buyer. So this is the work of a broker. So this is basically the work of a broker. However, instead of them being middlemen between you and another buyer or seller, they are also the middleman between you and what is called a liquidity provider. What this means is that the broker will match up your trade with a liquidity provider such as a bank or another financial institution to take the other side of your trade. So most of these things are done with an advanced technology now online. Before it used to be physical. It takes time. You go to your broker and place your trade, and then your broker will look for a seller. 6 crucial things to consider when choosing a forex broker. Don't forget this, though I may later recommend a broker for you, but for now that you will be starting, you will just need to start with any broker. I will recommend the ones you can open a demo account, but when you start to trade in the foreign exchange market, I will eventually share some of the details with you. Now, I'll have a Telegram channel in the description of this video. You can join the Telegram channel. While you are learning, we'll be sharing signals together. I will be updating you on the trades I will be taking. You will also be updating me on the ones then we discuss together. Okay, now you talk about security of that brokerage. Are they recognized? Have they registered with any regulatory body? You have to know about this. There are several regulatory bodies that they need to be registered with, okay, before you can select them as your broker. Transaction costs. I told you that you can pay either through a spread, That is the difference between the bid and ask price. I will discuss that subsequently. Then you can also pay through a commission. It depends on the broker you are using. You can talk about deposit and withdrawal. The most important aspect of trading is to make profit. And if you can only deposit easily and find it difficult to withdraw, then that is not a good broker. A good broker should be able to make withdrawal so easy for their clients. So you need to check their withdrawal reviews. How good are they? Trading platform. A good broker will provide their clients with a good and interactive platform to do analysis with enough technical tools. If your broker does not have that, you can avoid it. The most popular is actually MT4 and MT5. Then you can talk about TradingView. Execution. If your trade are not executed at that exact point, we call it a slippage in the market. It's not good. A good broker should be able to place and execute your order in that exact time you're executing trade. Customer service. How good are they in responding to their clients? If you cannot find them anytime you want to talk to them, I think it's a clear sign that they are not a good broker. So these are the things you must pay attention to if you're selecting a broker. Don't forget to check these things. If they don't have a good review about this, you should avoid them. So this is basically the theoretical part of everything you need to know about the foreign exchange market. It's just a brief explanation of everything you need to know. I will subsequently show you that. The next lesson will be on how to place trade in the foreign exchange market. We will start doing the practicals right now. And don't forget to join the Telegram channel. So I will stop this video from here. Thank you guys for watching. Make sure you turn the bell notification for the next video, and then if you're watching this and you have this suggestion video, just click on it and start watching from there. Thank you guys for watching. See you next time.